We're a team of approximately 25 here in London, fund managers, and we have approximately $1 billion under management across a range of equity funds, and including a EIS business. Renewable energy is no longer qualifying investing, and our Guinness EIS, which we raised and invested about 60 million into, was initially energy. We then expanded it to more broadly to sustainable infrastructure, and this year we've expanded it again, but maintaining those investment themes that we particularly liked from the sustainable infrastructure sector. So, for example, waste processing is still a qualifying trade under EIS, and something we're looking at as it's an asset-backed investment area. But there are lots of other sectors which we are interested in, and we've been developing a portfolio of opportunities to invest in from our Guinness EIS. Following the asset-backed theme, we're in talks with a nursery group who have nurseries, and they are looking to buy the properties and expand their group. We've also been in talks with other businesses, gyms, again with a similar sort of profile. And this is about underpinning investments with assets and obviously ongoing cash flows to give some visibility of returns. And it's about focusing on capital preservation. And I think that the concept behind that is all EIS is high risk, but by focusing on capital preservation, we're looking to preserve the initial investment as much as possible while trying to generate some growth through investing in good quality operating businesses. That is the intention, yes, and we're very much looking at the investments that we're lining up have that at the heart of the investment rationale. It is, I think, predominantly trade sales is an area that we can use to affect exits, and we closed 3 earlier this year, selling 3 of our investee companies, and we returned just over £1.20 to investors, which was in excess of our target return. I think on a localized basis there are always opportunities, and in terms of the sales process, obviously a trade sale, management buyout, it's possible to leverage these businesses to facilitate either of those. And there is obviously with an asset-backed business, there's always the ability to liquidate those assets to enable return of cash. So I think we're confident that we have sufficient options and opportunities to facilitate exits. Thank goodness we haven't had failures. That is the nature of the capital preservation model, is looking to mitigate that. Similarly, we're unlikely to have to massively exceed our target return. Obviously, I'm talking about the Guinness EIS there. We've had instances I can point to in our AIM EIS, for example, which has a much wider variance of returns, whereby we've had stocks that have halved in value. But with the capital preservation model, we'd look to have a much lower variance of returns. I think that the asset backing underpins the value of these investments. So yes, that's but not. I think if by that you mean have we actually had to sell assets to liquidate a company, then no, that's not something we've done. I think Guinness Asset Management is first and foremost an investment firm, and we look at investments from we look at potential investments as from the perspective of investors, the quality of the investment, not the tax opportunity. And I think that's so important as a starting point. Similarly, for the Guinness EIS, we're looking at capital preservation. We're looking at asset-backed investments, which can help maintain that. So it is about having assets to rely on within the structure of the investment. We are a reliable and experienced investor team, and we communicate clearly with our investors. We put their interests at the heart of what we do, and we research and do thorough due diligence on all the companies we invest in.